Friday, March 18th, 2022, Monaco 64, home of alternative economics and contrarian views. So today I'm recording on my computer on Zoom. So the quality might be a little different. I'm not using my wireless microphone, but it's easier for me as I'm away from home. I do have all the other equipment, but it's just easier when you're on holiday, trying to relax a bit. But don't worry, I have been following things. I've noticed that the Bank of England came out, they raised rates by about 25 basis points or by 25 basis points. The Federal Reserve as well came out and said that they're going to raise rates a total of 7 times this year. Well, I think it's all mope, as Jim Sinclair would call it, or management of perception economics. So we're going to look at the central banks and how they basically want to have their cake and eat it. And the people who are going to suffer are the general public, of course, as always. Before that, I'd like to touch upon what's going on geopolitically as it pertains to Ukraine and Russia. And I haven't really been touching upon that much, mainly because the way I feel about it is that we've got the mafia bosses fighting each other. And who are the mafia bosses? Well, it's the West and the East, and we are in between, and we'll be hurt, not literally hurt physically, but we're already getting hurt with all the disruption to commodities, to the rising prices. And I don't blame what's happening for inflation. Inflation is something totally different. Inflation is when the central banks and governments spend and create funny money out of thin air, which leads to a lower purchasing power of the currency. So yes, my philosophy right now is to batten down the hatches and try not to get hurt. The analogy would be in the 1920s, 1930s, Chicago mob fight in the streets. You wouldn't want to get out when they're like machine gunning each other. You'd go in your house and like shut the door and try to avoid getting involved. That's it. Try to avoid getting involved. I don't have an opinion. I listened to a video from about a year ago, and I'll put a link to it below in the description and up in the cards. It's by Baldwin Bankrupt, this English guy who travels around the former Soviet Union. And he was in Eastern Ukraine talking to an old grandma, and she said, yes, these are all our masters fighting each other, and we get hurt. And that's all it is. So would you want to take sides with mafia bosses? I wouldn't. And that's why maybe I haven't been talking so much about it. But that's the way I feel about it. Back to central banking. So I'm going to share something here that I saw yesterday in the Daily Mail as it pertains to the Bank of England. And there you go. And there you go. It says cost of living catastrophe. Britain faces double-digit inflation for the first time in 40 years, with mortgages, fuel, and food prices set to soar as the Bank of England hikes interest rates to 0.75%. So they're even warning now that their phony measure of prices. And why do I say phony? Well, because it's very doctored to make it look as low as possible. So not even that measure, the CPI, is going to be able to be kept under 10%. So they're seeing that there's a danger of 10% rising prices. They'll call that inflation. But what do you think is the thing that's wrong with this headline. I mean, I don't expect everyone to know this, but for those who have a background maybe in economics or are even interested in economics, what you will see here is that they're talking about possibly 10%, definitely 8% CPI, but the Bank of England base rate is only at 0.75%. Yes, less than 1%, while prices are rising by 8 and possibly 10%. Well, the interest rate, the base rate should be at least 10 or 12%. And I noticed as well, reading through another article from the FT, which I won't share. I don't need to share it with you, but I'll give you the background on it. Basically, there's 9 people in the Monetary Policy Committee, and one of them voted not to raise rates this time. There was expectations that they'd raise by 50 basis points this time, and now they're already talking back the rate hikes. So, and that's why I'm saying they want their cake and they want to eat it too. They think that they can control prices by keeping rates still historically at levels that are a complete joke. On average, in the last 300 years since the Bank of England has been around, unfortunately, the base rate is average probably 5%. And here we have the expectation by the Bank of England that the CPI or inflation will go to 10%. And we won't even see, I would say, interest rates back up to 2. We probably will see longer term rates. They might lose control of that because they don't control that as well or as much, especially now, the fact that they've stopped doing QE. So don't think that your mortgage rate will stay low. It will probably rise quite a bit. And they're playing with fire, the Bank of England. And why is that? Well, because if the general public lose faith and confidence in the currency, the demand for the currency is going to drop through the floor. And when that happens, you get hyperinflation. And what does the demand for currency mean? Well, people will want to spend their currency versus real things as quickly as possible. The Bank of England and the Fed and other central banks, they haven't studied hyperinflation and currency collapse like I have and others in the alternative in the gold space have. And why is that? Well, because they don't think it can happen now, and they think they're a lot cleverer than the people from the past, but I think they're going to be proven wrong. And with that, I'm just going to go also to an article actually in the FT about the Fed, and even the FT is like kind of critical about the central banks, which is interesting. They're not going to be, of course, uber critical like I am and others are. But look at what this guy, Robert Armstrong, says. The Fed wants it all. So basically, he's talking about the fact that the Fed thinks they can stop inflation by lifting rates really slowly and not at great amounts. They're talking that they want rates maybe above 2%. And just like they were wrong about transitory inflation, they're going to be wrong about this, because I think the rising prices are going to remain elevated. Of course, they're counting upon what they call demand destruction. They think that people are going to be so hard up that they're going to stop spending, so prices will start dropping. But I think they've got something else coming, because when you have hyperinflation or currency collapse, the economy is not doing well. It's not a cost push phenomenon. And with the economy slowing down as well, you're going to have less goods being produced, I would say. We're seeing also a shift from the private sector to government as well. A lot of government spending, and we know that governments don't produce wealth. So I think it's going to get worse. So even the FT is not too convinced. They're also talking about the fact that the FOMC, which is the MPC version of the Fed. MPC is the Bank of England. It's a group of people who decide where the cost of money should be, which is something that's not right either. They have really differing opinions. So they've got a problem. They're not really seeing eye to eye. They have no idea what's going to happen. And it's interesting that it says here at the end of this article, and they do talk about gold, but I didn't read what they said about gold. Don't really respect the FT to know much about gold. But it says, is it possible to subdue high and pervasive inflation without costing anyone a job? The Fed hopes so, and so do we, but it's a cruel world out there. And that was from Ethan Wu. I don't know who Ethan Wu is, but I agree with his prognostication there. And just before we look at the markets this morning, just want to show you the consequence of the policy of inflation of the central banks, and how it really doesn't have much to do with what's going on in the Ukraine right now. Yes, it's going to push energy prices. It's going to make things worse. But this has been happening before the geopolitical crisis. And I thought this was very interesting. New Yorkers struggle to pay utility bills as electricity prices soar. So more than 1 million customers in arrears prompt action by state government. So there you go. They're promising to help another $400 million. And you just multiply that by other cities, other states, and it's going to make things worse, because where does government take their money or taxes from? Well, from the public. They're trying to help. So that's the old Keynesian fallacy. But yeah, I thought this was really interesting that people are starting to get hurt. So you can see this started in February 2020, unpaid bills. New York residents fell behind on the utility payments at historic levels in the pandemic. So it's not because of the Ukraine, and it's getting worse. So there you go. And as I said earlier, be it in the geopolitical war side of things or in the economic side of things, it's the general public that gets hurt. And don't fall for the trap and think that central bankers and governments are there to help you. And that's why you need to try to be as self-sufficient as possible and not depend on them for your survival or livelihood. That's something we've always touched upon here. So with that, we're going to look at the markets this morning. So yesterday, I published the interview that I did Wednesday night with Michael Oliver. And the markets have been quite wild through the FOMC meeting on Wednesday. And then yesterday, gold and silver were all over the place the night of the FOMC or the afternoon of the FOMC. We even got below, I noticed, 1900. But now we've come back above that 1920 level that I said was a level we could retest. Yesterday, we got to a high of 1950. So gold and silver are still doing well. The miners, I've noticed my miners, gold, silver miners, and some commodity stocks are doing very well as well. So as I said in the interview with Michael Oliver, which I recommend, patience is key. Nothing's changed. Central banks are going to err on the side of keeping inflating. So I'm going to share the screen here, actually, so you will see the live prices today. I usually read them out. So let's share this. Okay, so there we go. We can see what's happening here. Spot gold. Well, by the way, it's 8:37 a.m. Swiss time. Yes, I've been doing the videos a little earlier, mainly because for some reason I'm getting up earlier here in Switzerland, and that's the way it is. So we're around 1932, as you can see. High's been 1945 and the low 1926. Silver is down about 18 cents, 0.75% almost. Range has been 25.46 to 25.14, and we're at 25.20. Yeah, the stock markets, they have rebounded. I noticed the NASDAQ now is down only 12% year to date. It was down almost 18 recently. I just think that's a rebound in the bear market. Right now, the Dow future is down 132, just over a third. NASDAQ is down 105.75, and the S&P 500 is down 0.5%. FTSE is fairly steady here, 73.94. We got the Euro stocks unchanged, Euro stocks 50. Currencies, we got sterling down slightly, 131.43. The euro back above 110, 110.70. It is down, but back above 110. And the dollar yen, the yen has been very weak of recent. We are almost up to 119 right now. Dollar yuan as well. Dollar's firm against the yuan, 637.33. And we'll switch over here to the other currencies. Aussie dollar up 0.2, almost back up to 74. The dollar is down 0.1, as you can see, versus the Canadian dollar, 26.13. And the Kiwi dollar is up 0.8% at 68.90. The commodities right here, WTI back above 100, 103. So yeah, it didn't stay below 100 for too long. We're up 1.3%. Brent as well, 106. And high-grade copper, pretty much near the all-time highs here. And that's another reason why silver is so undervalued still. There's a lot of room in silver. It's frustrating, but we need to hold on, I think, definitely. So high-grade copper up a third at 471. And we'll now look at the 10-year yield, the US Treasury market. I've been noticing that the yield curve has been flattening. It's close to getting inverted, and that's a bad sign. That means the economy is approaching a level where it could be falling into a recession. So if you look at the 2-year note, it's at around 193, and the 10 years at 217. So that's only 24 basis points difference. That's been dropping. That difference has been dropping for quite a while now. And there are other parts of the curve, like the 7 to 10 year that are inverted, as you can see here. And of course, the 20 to 30 year spread are inverted. This morning, the 10-year yield is down about 2 basis points, as you can see, at 217. So that's it for today. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.